Good morning, Morena, everyone. It's Stuart Williams here. Thank you very much for joining us for the monthly update. We've got a great batting order today. First of all, we've got Andrew Hunt, who's been in the country actually for the last couple of weeks. Good to hear from Andrew. Then we're going on to Matt Johnson from the fixed interest team. And then we finish with MDC from the equity team. As a reminder, if you want to type some questions into the Q&A section, if there is time, I will ask the various speakers to answer those questions. It's a great time to be having Andrew in the house, and indeed the other investors as well, as we wrestle with a coordinated interest rate rally around the world, and we've got lots of live information. I think the most recent one being GDP overnight in the US. With that very short introduction, Andrew, thanks for being with us, and we look forward to your insights. And please, if you're online and you want to ask questions of Andrew, then fire them through. Over to you, Andrew.
Thanks a lot, and always great to be back here. I think this is an incredibly interesting period in terms of markets and the global economy. And in fact, I'd actually put markets in one category and the real economy in another, in that we seem to have quite a sort of parallel universe occurring between what's occurring in financial markets, which I think have become almost entirely flow-driven, and what we're seeing in the real economies. Excuse me, I picked up a cold in the South Island, so we can blame that for my slightly. So my first chart really addresses this question of whether central banks will ever end QE. We're looking at this top panel. That is the amount of household saving in the developed world minus the amount of government borrowing. And so as we stand at the moment, governments are going to attempt to borrow more from their citizens than their citizens save. Now, historically, the only way that that can normally happen is either you borrow a lot of money from somebody else abroad, which is increasingly difficult in this world. The emerging markets don't, as a rule, have the big surpluses they had to lend to the developed world. Or you have to use funny money. You have to print money, use quantitative easing or asset purchase programs or whatever set of initials you'd like to use. And central banks have never really weaned themselves from that, or governments haven't weaned themselves from that. We tend to think that quantitative easing was something that just occurred in the pandemic. Actually, it was occurring as recently as 4 or 5 weeks ago. It occurred massively in the fourth quarter of last year. We had the European Central Bank saying it was doing quantitative tightening, but actually it bought over 100 billion euros worth of bonds. It was still doing QE. The Federal Reserve didn't buy bonds, but it found other ways of adding liquidity, technically by running down what's known as the reverse repo facility, and the government also shed some of its cash balances. The dying days of the UK's Conservative government, running down their cash balances, taking sterile money out from the central bank and releasing it in the economy, so they didn't have to issue bonds. Not issuing bonds and taking money out of the Bank of England is just the same as quantitative easing in a monetary sense. Japan was still doing quantitative easing, they just called it yield curve control. And if we look at those major central banks, in the fourth quarter of last year, they did the thick end of 2 trillion Kiwi dollars of quantitative easing. That run rate actually exceeded what they did in the worst days of the pandemic. So no wonder markets were up. And they continued that intermittently in the first quarter and certainly did a lot of that in May and June. So we've never really gone through weaning ourselves off quantitative easing. And I think that's really telling us that there are two issues in the global system. One, that the real economies are inherently fragile. And we're obviously seeing that in New Zealand. As I've just been in the South Island, but it's terrible ski season down there. This economy is clearly very weak. And I think there's a number of issues for that. I would suggest and this is globally, not just New Zealand, over-regulation, lack of income growth, and also I think this is quite an important feature, and I think it's very applicable to New Zealand. I think we're seeing a lot of people globally just looking at the future and saying, you know what, I don't think I'm actually going to be richer in the future than I was in the past. And if I'm not going to be wealthier in the future, it makes no sense to borrow from the future, to borrow income from the future by borrowing today. So to spend it today, that actually makes no sense if you're changing your long-term expectations. So in sake of argument, say Queenstown, global warming may be a big problem for the ski fields. Perhaps it's not going to be such a vibrant tourist destination. I'm not going to borrow a huge amount of money to buy that next property or to speculate in the property market. But you're seeing that in the United States, particularly in the middle classes, just starting to happen in the UK. I think started to happen in Australia a few months ago as the impact of the China slowdown finally started to bite. So you've got this weakness in the real economies. Governments have been trying to offset that with fiscal policy in most places, leading them to borrow lots and therefore to keep using QE. But that really tells you this is a very fragile system that is dependent on ever increasing amounts of government spending. And if you take that government stimulus away, as indeed New Zealand pretty much has, then your economy falls over quite fast. And I think it's really interesting to look around at some of the global indicators at the moment. The US, whether Trump is elected or not, I think a lot of companies are quite understandably restocking ahead of possible tariffs. So they're importing a lot from China, they're importing a lot from Asia now in case they can't in the future. So we've seen, as we saw overnight in the GDP data, we've got a big inventory build occurring in the US. Normally that would create a boom in Asian exports. It hasn't. There's been a rise in volumes, but not in prices. So that, I think, we've got that big stimulus from the world's biggest economy in terms of the inventory building, and yet you haven't seen that reflected in an export boom in Asia. And I think that really is symptomatic of how weak the global economy is intrinsically and why we're seeing this big rally in rate expectations. And I think that will continue. I can easily see the Federal Reserve forced to cut interest rates in the coming months, possibly even quite quickly, because of this softness in the global economy. But then you look at markets, and if we take away the last couple of trading days, which I think were really quite a predictable correction, we seem to have this buoyancy that everything is going to be fine. And I think that is due to the other big theme that's going on, and that is a hidden credit boom. If you think back to 2007, 2008, probably 99.9% of the world's population had never heard of CDOs and never knew that there was leverage on leverage on leverage in esoteric mortgage products. And one of the reasons for that was because the statisticians didn't know that boom was occurring. They weren't measuring it because the statisticians weren't capturing it. The regulators, the policymakers didn't know about it. And they only found out about it and started regulating it after it blew up. And I think we're seeing a similar type of event in markets at the moment. That quantitative easing that I've mentioned central banks have been doing, particularly in the United States, where they've been running down reverse repos. And what that does is to add liquidity to the banking system. If you go and see some of the major banks, as indeed I have, you ask, well, what do you do when that money arrives? When these funds come out of the Federal Reserve, come onto your balance sheet, what are you doing with it? And they all say, particularly actually the smaller regional banks as well, well, there's no way we're going to lend to somebody in the real economy. People perhaps don't really want to borrow. We don't want to lend to them. We've got capital adequacy concerns. We think the economy is slowing, so we don't want to take the credit risk. So all we do is we lend it to somebody else. We lend it to some other financial institution and let them do what they want with it. So money's coming out of the Federal Reserve, going into the banks. Often you get this QE, so the government is spending the money, comes into the banking system. The banks aren't lending that to the real economy. They're lending it to private credit. They're lending it to private equity. They're lending it to non-bank financial institutions that originate subprime mortgages. And because these non-bank financial institutions are generally outside the scope of the statistics, most people are missing what is in fact a $1.5, maybe $2 trillion flow of credit into the US economy. So, 5-10% of GDP type flows. This is almost as aggressive as we saw during that mortgage boom. And it means for companies, or certain companies, you've got access to credit, you can borrow, you can invest, and that was one of the other messages of the GDP data last night, that there are pockets of strength within US private investment, but it is very much funded by these private credit flows. Now, what I find really interesting is that probably 3/4 of this credit is actually being used to buy equities one way or another. So you're finding private equity companies taking out what are called NAV loans. So they'll borrow against the assets in the fund so that they can pay out the limited partners without selling assets. Also, they can simply gear the portfolio, and often they then gear the companies that are in the portfolio. You look at who provides the leverage to the private equity companies. It's often related private credit companies who are leveraging their own portfolios by borrowing from the banks to provide credit so they can provide credit to the private equity. So you're building this leverage on leverage on leverage phenomenon. And it's resulted in some very strange things in the data. I mean, it may surprise you to know that the biggest single source of external financing for the US business sector is now unclassified liabilities, which are these private credit flows, private equity flows. They're not in the data. We're not therefore technically seeing them. And it's not the sort of $100 billion a year that people tend to assume it is. It's 10, 15 times that amount. Now, the rates of interest that are charged on this stuff are really quite high. If you're talking venture credit, which is the really subprime end of the spectrum, you're looking at a 25% interest rate. Private credit is generally somewhere in the low teens. So the carry cost of this boom is quite high. But the fact that people have been prepared to borrow that tells you they're not really worried whether the Fed funds is 3, 4, 5, or 6. That might be hurting the mortgage market and real people, but out in this kind of hidden credit boom, you're not really that interest rate sensitive. What you are sensitive to is the amount of money coming in from the Federal Reserve, coming in from the government that keeps that whole system going. As long as it's inflating and markets are rising, you'll pay those interest rates because your effective real interest rate is still negative. But if you stop the credit and the boom stops inflating, then this thing will deflate quite quickly. Now, I don't think that is imminent. We've seen a little bit in the last few days, but that really is just seasonality. The government borrowed a lot of money and that removed some liquidity from the system. That's just seasonality. And if anything, I think we're probably going to see between $300 and $500 billion more money added to that credit boom in the 2 or 3 months leading up to the election. So although we've got this global slowdown, I think will continue to see this boom in hidden credit, that much of it ends up being used to buy equities, to buy risk assets. So markets probably continue to inflate, I think, in the next few months, particularly the risk markets. Fixed income probably benefits from the global slowdown and particularly the fall in world trade prices that we're seeing at the moment. And a lot of that is to do with China. China's economy is getting really very weak. I think the bigger question is what happens next year. Next year, if we've had a big fiscal stimulus in the United States ahead of the election, which looks like we will have, and we have another, let's say, $500 billion of liquidity added to the system through this credit boom, the chances are the US will finish the year strongly. Inflation probably will come back. If I look at my capacity utilization index for the US, it is still above trend. So if you get any acceleration into the election, inflation will start to come back. So the US next year, I think, will probably not be cutting rates, may even raise rates a bit, and will have run out of the money that's sitting in the reverse repo. The government will have spent all the money it can. So that flow of money into the private credit system, I think, will start to stall. That, I think, creates a very messy environment, certainly an awkward one for risk markets, one that probably gives us quite a strong dollar, particularly against countries like New Zealand that don't have that private credit boom to anything like the same extent, that are already quite weak, that are affected by China's very deep slowdown. And certainly I don't think China's economy is going to pick up in the near term. The recent party plenum was all about national security, not about revitalizing the economy. In any case, revitalizing China's economy, I think, will be very difficult. So I think we'll start to see weakness in risk appetite, a US real economy that perhaps is more resilient than others. And so the Reserve Bank of New Zealand, who I think probably misread the state of the economy back in May, certainly the meeting I've just had suggested I think they'd probably like to take back a lot of what they said in May. We'll see, I think, easily 100 basis points of rate cuts here, possibly more over the next 12 months. New Zealand rates starting to diverge in direction from US rates, and that probably gives us a very weak Kiwi dollar. I think we could probably see a 10 to 20% reduction in New Zealand's real exchange rate over the next year as New Zealand, with its negative output gap, the economy slowing very sharply, diverges from the US. Australia, a little bit behind New Zealand. The UK a bit behind Australia in that respect. Europe also very weak. The weakness in China is providing a very significant asymmetric shock to the core of Europe. So while I'm quite relaxed about the economic prospects for places like Spain and Italy, if you're Germany, France, Austria, the Netherlands, a lot of weakness there. So I think we'll see the Europeans cutting interest rates and maybe even Europe having to go back to quantitative easing next year, certainly ahead of the Federal Reserve. So I think the next 12 months, we're going to see a lot of volatility in currencies as different central banks enter their easing cycles at different speeds and at different points. Probably New Zealand leading the pack, but that will, I think, be reflected in the New Zealand dollar. And much of what we're seeing, the weakness here, or Australia and Asia in general, is of course down to China. And I will just show a few charts on China. Certainly the economy is weakening. And it's weakening for a number of reasons. People tend to just think of the housing market, but there's more going on than that. We have a tightening of fiscal policy, particularly in certain regions that aren't perhaps that loyal to Beijing. Local government spending in about 12 provinces has all but collapsed. And so that's a big fiscal tightening on top of the weakness we're seeing in world trade. We've got a major compound interest problem in the private sector, particularly the property developers, but also just the general business sector. Interest expense is compounding much faster than GDP growth. That means you're going to see more bad loans. And at the moment, we think roughly half of all credit growth in China is just the evergreening of loans. The banks don't want to admit that the loan is bad, so they lend more money, chuck good money after bad, just so they don't have to report a bad loan. But that's creating a banking crisis. The banks aren't getting any income. And interestingly, and I think this is again largely political, the PBOC has stopped providing assistance to the banks. So the banks are providing assistance to the companies, which cost them money, but they're not getting any assistance from the central bank. So the banks are going to get squeezed. That clearly is not sustainable. So I think we'll see a further tightening in credit conditions, and that affects some of the SOEs and the business sectors, many of whom are cash flow negative, actually quite significantly cash flow negative. They won't be able to fund their operations. That's more of a slowdown. And then we do get to the property market. And people, I think, get impressed by the thought of $30 billion or $50 billion in aid for the property market. Unfortunately, you need to put a 0 or 2 if you were going to solve the problems in China's property market. We think that the property developers have sold 6 billion square meters of apartments more than they've delivered. The cost of producing those apartments and actually fulfilling the contracts would be somewhere 50–60% of China's GDP. And the property developers don't have that money. They did have it, but they used it to buy property in Auckland, in Sydney, in Melbourne, in Long Island, in New York, and of course on the west coast of the States and throughout Europe. That money has escaped from China. So if the government wants to rescue the property market, it's not just about falling property prices, it's about fulfilling the contracts that these property developers are defaulting on. And that is a massive amount of money. And there's no sign that President Xi has any intention of doing that. So for your Chinese middle classes, if you actually own the property and you have that, and you have physical possession of an apartment, it's going down in price. You worry about the negative equity, the balance sheet effects. But probably a third of all the apartments that have been sold since 2016 don't exist. And that is a huge hit to the household sector's wealth. So I think Chinese consumption is going to remain under a cloud for several years. You've got that credit crisis, the credit crunch in the banking system that will affect the corporate sector, and a fiscal tightening on top. So I think we are going to see continued weakness in China. That, of course, affects this part of the world. And it's one of the big reasons that we're getting this lack of coordination now. Markets are rallying in a coordinated fashion, but I think central banks won't be quite so coordinated in terms of when they react. I think the RBNZ is going to get quite aggressive at easing over the next 12 months, certainly much more aggressive than the Fed, probably a little more aggressive than the European Central Bank, with Australia a little bit behind. So that is my attempt at going around the world in 20 minutes.
Excellent. Thanks, Andrew. we can have a great conversation now. We've got 10 minutes or so. So as a reminder, if you want to ask questions, fire them through. Maybe I'll just start off with, I mean, obviously, new Prime Minister or another new Prime Minister in the UK, and notwithstanding independence of Bank of England, is there anything in particular that we should expect this government to force into the economy? I guess in particular, since they've got such a strong mandate. Yeah, so your thoughts on that would be good.
Yeah, the subject of the mandate is interesting in that they did poll fewer votes than they did in 2017, that it was more the split in the Conservative Party to reform that handed Labour an election victory. So there is a debate as to whether they really have a mandate. They have a big majority, but they don't really have a popular mandate. And I think the big majority is actually a problem because the main opposition to Keir Starmer, the Prime Minister, is probably actually the left wing of his own party. So we've already seen some of that reflected in tensions. The bottom line is, according to their current spending projections, which I think are optimistic, they're going to try and they're going to try and borrow 3% of GDP more than the UK household sector saves. So I think that the UK really is either going to have to go back to some sort of monetized deficit, or we'll see a gilt stroke sterling crisis quite quickly. Now, this morning, there was a little headline that passed through my news feed. The Bank of England did a record repo facility. So they are doing quantitative tightening and then sterilizing the effect by lending money to the banks. So at the moment, it looks as though, for fear of having a gilt crisis, the Bank of England is, with one hand, doing quantitative tightening, with the other hand, is putting the money back in through the back door. And I think that's probably how the system, or how this government and the Bank of England will operate for the next 6 months or so. The economy is kind of okay. It's not growing strongly, but it doesn't fall in a heap. There is a fiscal stimulus, and it is monetized through this backdoor route. But ultimately, I think that will mean inflation remains sticky, and eventually the markets will start to notice, and I think we'll see some weakness in sterling. And like New Zealand, the UK has a very high import content within its consumer price index, so that keeps the inflation numbers high. And ultimately, the government does have to issue debt. We haven't issued any coupon really all year. So start to get some supply pressure as we get into next year, the inflation news not being great, and just this realization that there's a backdoor QE going on. I think next year we could see the gilt market take fright and sterling take fright, and then you get a proper slowdown in the United Kingdom, probably middle of next year. That we're in a bit of a phony war at the moment. A lot of people saying the new government, because it's got a majority, has credibility. I don't think they're going to have that much credibility with the foreign sector. So they've got a honeymoon period. But just before the election, I was quite vociferous in saying this is an election you really didn't want to win. Because I think there was a bit of scorched earth by the previous government. They knew they were going to lose, and they wanted to make sure that Labour was only a one-term government by leaving them in such a mess. And I think that might have been the wrong thing to do morally, but it's probably worked politically in that I think in a year's time, the new government is going to have some big problem. There's some big questions to answer with regard to fiscal policy. I think this could be a Labour government, a bit like the one in 1976, 77, that ends up tightening fiscal policy at the behest of the markets, which really isn't going to go down very well with their core voters.
Perfect. Thanks for the comprehensive answer. Shall we jump across the ditch to the Atlantic? And I guess we have to talk about the prospects for that election. And I guess the interesting thing that I'm contemplating with Trump is, people think about him as being, quite positive for markets, but I guess you mentioned the potential of tariffs already. So tariffs versus trade wars versus, again, the most instructive or informative central banks action, and how that influences the rest of the world, if you could, please.
I mean, I think it looks to me probably that appointing Harris means that the Democrats don't lose the House. So we'll probably have some obstacles, assuming we do get President Trump, which I guess is likely. The chances are the Trump tax cuts won't be extended, which will be a hit to household incomes. Whereas we will get tariffs, which is another hit to household incomes because it obviously raises the price of importing goods into into the United States. So I think actually potentially it's probably bad news for household incomes in 2025, and that does give you the drift towards the recession. I think also there's a foreign policy issue here. We talk about tariffs and trade wars in isolation, but this is part of a bigger game. You know, Trump is he's not committed to defending Taiwan. He's not committed to anything much in terms of foreign policy, as we're seeing in Ukraine, and that obviously encourages geopolitical rivals to be more aggressive. So I think we'll see more political tension, not just trade tension, that the trade tension is part of a bigger thing. And that probably is not great for global trade. I mean, tariffs in the US is deflationary for the rest of the world, inflationary for the US. Not extending the tax cuts is deflationary for the US, certainly in terms of spending. It does give you that eventual US slowdown, which will reverberate around the world and gives us lower rates. But I think it does generate the chance, certainly increases the chance of a global recession in 2025. I say New Zealand in that already, ahead of the game there. But then when New Zealand wants to recover, it will be harder given that global environment. But I do think that a Trump presidency, Democrats probably holding the House, probably is not great for global growth. It creates some uncertainty. And then you have to superimpose that hidden credit boom that I talked about earlier. That is reliant on funds coming into the system all the time and some sort of good news story. And what worries me in 2025 is that in the attempt to support Harris, the government will have spent all the money that it can do, will have exhausted the reverse repos. I think they'll be exhausted pretty much by October, certainly by early November. So there'll be no more money coming into that hidden credit boom. And you've got questionable news about global growth, US growth, an inflation shock from the tariffs. That credit boom could end, and I think that really could be quite difficult for markets. So although I think there's this sort of assumption that Trump is going to be good for markets, I think the realities are that it's actually going to be quite a challenging environment. If we think back to when he was good for markets in 2017, there were two things. One, there were the tax cuts, which he could do, and now he can't, or he wouldn't be able to. Also, there was a $500 billion QE in the first quarter
Yep.
of 2017, which he can't repeat. So I wouldn't use 2017 as the template for Trump too.
Perfect. Thanks, Andrew. And just with a couple of minutes till we hand over to Matt, I guess the interesting observation, or interested in your observations on New Zealand and, how how far behind, I don't know, how far behind is the central bank where they really should be, because it does feel quite painful out here, and they seem to be, Ferg and his team have been quite vocal about some of their aspects, but they really don't seem to be listening. And so, do you subscribe to the idea that they might cut deeper, more quickly to sort of redress the errors of maybe the last 3, 5, 6 months?
I mean, there's what, 75 basis points in the market, and I think that's the least they'll do. They could well do more than that. You say they weren't listening. I kind of think the staff of the Reserve Bank were listening and they were writing it down, but that certain
Yeah.
people weren't reading what they wrote. And that gave us that main monetary policy statement that perhaps a lot of people would like to disown. My sense, particularly just from I mean, I've only really been back at work a few hours, as it were, but the meetings I've had this morning suggest that there's been something of a dramatic U-turn in Wellington over the state of the economy, probably an overdue one.
Yeah. Okay. That's good. We perhaps I'll fill the air with a few words, and thank you very much for actually being in our office. Thanks for visiting New Zealand and spending your hard-earned dollars. We look forward to seeing you in country again, and we'll hand over to Matt. So I think that's actually a physical handover. So if you flick that, oh yep, there he is. Yeah, a good introduction to your piece, Matt, and Hopefully you'll talk about the excitement of those 170 words from the Reserve Bank statement that got everyone so excited. So please, the floor is yours. Thank you very much.
Exactly. A few commonalities there with Andrew's story of perhaps a weaker economic environment going forward. Now, it's been a rather eventful month in fixed interest. We've had a very strong rally on the back of the Reserve Bank's potential pivot at the MPR. As things stand today, a 2-year swap is down some 72 points for the month, with smaller but equally impressive falls seen further out the curve. 5 years is down 53 points and 10 years is down around 34 points. Given these sizable moves, I'm going to share some views on the MPR along with second quarter CPI. I'll just get my screen up. Right. So the MPR was interesting, not in its no change decision, which was widely expected, but in the intentional change in tone of the statement and minutes, which, as I mentioned, are widely viewed as a pivot. For me, there were 4 key points in the statement. The first was that there was no mention of hikes. The second was that the Reserve Bank explicitly observed that monetary policy was reducing domestic demand and consumer price inflation. Third, the minutes expressed confidence that inflation will return to its 1% to 3% target range over the second half of 2024. And fourth, they stated that policy settings will need to be tempered over time, consistent with the expected decline in inflation pressures. And this is perhaps the most interesting statement in its use of the affirmative will and the conditional proviso with the expected. So all in all, a rather dovish set of comments, and notably different from May's MPS, where we received a higher for longer message with hikes considered and OCR cuts not forecast until the second half of 2025. So what happened in the intervening period for the RB to reassess its stance? Well, in one regard, nothing at all. The data and economic conditions, excluding CPI's absolute level, were pretty gloomy back in May. However, perhaps this is a story of the weight of observations building, such that it's increasingly apparent that monetary policy has done its job. Let's look at some of the releases along with 2-year swap to gauge market reactions. In the chart, I have highlighted the May MPS and the July MPR dates in yellow. We can see that 2-year swap peaked after the hawkish May MPS and has since fallen over 70 basis points, with the bulk of this fall occurring after the July MPR. Also highlighted are data releases split into 3 key categories. In blue, we have a set of key data that feed directly into the RB's models. In green, we have bank-derived economic data that could be viewed as supporting indicators for the RB, but are unlikely to be in their core set of data. Whilst in red, we have US inflation data. None of these data points would have resulted in upside concern for the Reserve Bank. However, the most influential on a standalone basis was likely the QSOB, or Quarterly Survey of Business Opinion. On screen now, in the top left, we can see an extract from the survey showing the percentage of firms expecting higher costs and prices. What's notable is the expected selling price line in green has rapidly fallen and is at a level that is historically consistent with low inflation. Likewise, we see the expected cost line in blue has also fallen and is close to approaching historic levels consistent with moderate cost push inflation. The Reserve Bank looks closely at the survey and would likely have taken comfort with these soft pricing and cost expectations. Supporting this, we see a set of generally weak economic data. In the bottom left, we have the ANZ Survey of Business Opinion, which agrees with the QSOB that pricing intentions are moderate. Whilst in the top centre, we have the ANZ Truckometer. This series has a really strong correlation with GDP. What's interesting here is the weakness of the most recent data, which is the third largest decline, with only those two COVID lockdown periods worse. Bottom right, we have the BNZ Seek Job Ads Index, and this is a gloomy story for the labour market. The trend is clearly down. We not only have less job adverts, they're down some 28% year on year, but we have a record number of applications for these jobs, up some 57% year on year. So less jobs, more applicants, very consistent with reduced wage pressure and increased unemployment. Bottom centre, we have retail sales, which despite a small positive uptick, have a very weak trend. I'll note here that prior to this uptick, we had 8 consecutive quarters of declines, and that this occurred despite strong population growth from net migration, which should have supported spending as migrants established their lives in New Zealand. Essentially, Kiwis have shut their wallets for all but the essentials, with discretionary spending really dialed back. To put some colour around this, we could look at new car registrations. They're at their lowest level in a decade. We could look at Resimac, a non-bank lender who has recently left the New Zealand lending market, with this decision heavily influenced by the lack of demand for additional borrowing, again showing that consumers are hesitant and lack confidence to spend large amounts of money. Whilst finally, perhaps as an anecdote, we continue to hear stories from the hospitality sector around the lack of patronage. Which brings me on to the last chart in the top right, net migration. It's been running reasonably strong, still at around 83,000 people for the year inwards, but the trajectory and composition look to be deteriorating. In the teal area, below the horizontal axes, we see departures are rapidly accelerating and stand at historic highs. Whilst in the dark blue area above the axes, we see arrivals are beginning to slow. So perhaps that story of things not being so good in New Zealand is starting to get through. Previously, population growth was a strong positive for economic growth and was undoubtedly supporting consumption. Should this declining trend continue, we'll not only have lower economic growth, but we'll see less demand for housing, which in turn will reduce pressure on rents, a key non-tradables item at around 10% of the CPI basket. So all this data I've just highlighted is highly consistent with reduced inflation pressures, which brings us on to inflation. On screen now, we have New Zealand and US inflation numbers. First, we can see in the US, both CPI and the Fed's target of PCE inflation are inside the band. We also see in the bar chart on the right that more recent monthly prints suggest a downshift, perhaps providing a foundation for the Fed to cut later this year. There's a similar story in New Zealand. Second quarter CPI came in at 0.4% for the quarter, which was towards the bottom end of market expectations and gave us a headline CPI of 3.3% for the year, rather close to the RB's target. Non-tradable inflation, however, does remain elevated at 5.4%, which one might think is a roadblock for the RB, as they've been very much focused on non-tradable inflation. We can understand this concern. Non-tradable inflation is historically more persistent than tradables. It's been sticky and it's well above target. Yet I will observe it's heading in the right direction, and the 5.4% number for the year was bumped up by a one-off methodological change to the measurement of road user charges that added 0.13 percentage points. We should also remember that despite the RB's cherry-picking of focus, its mandate is headline inflation, not non-tradable inflation. At the risk of cherry-picking myself, I'll highlight that insurance, rents, and property rates and related services accounted for over a third of the headline inflation number, and that monetary policy has little impact on these categories. So one can argue the RB should look through these sources of inflation, as they do with supply shocks. I also take comfort that when we get third quarter CPI, we'll be dropping off a 1.8% quarterly print, which we can see in the bottom right chart. The base effect from this alone should see CPI inside the RB's band, perhaps giving that final piece of insurance for them to begin easing. So let's look at market expectations for the RB's future OCR decisions. On screen now, in the chart on the left, we have market pricing implied OCR levels, and boy, are expectations high for cuts. Markets are looking for close to 166 points of cuts over the coming year, and another 66 points in the following year. In practical terms, with the Reserve Bank meeting 7 times a year, this implies they cut 25 points at 6 out of 7 of these meetings, perhaps 25 at all 7. It also requires them to begin cutting prior to receiving third quarter CPI, which is out on the 16th of October. And here I'll go back to that line in the NPR. Policy settings will need to be tempered over time, consistent with the expected decline in inflation pressures. My read is inflation's continued decline is a key condition for this tempering of monetary policy. In other words, the Reserve Bank is data dependent. Now, one can argue that the weighted data out there is enough that the RB could start moving immediately due to policy lag. Against this idea, the last thing the RB will want is to begin easing, then experience a upside shock to CPI, perhaps from a geopolitical event or some other surprise domestic event. The RB will also be aware that easing has already started thanks to markets pricing future cuts. We see this clearly in the mortgage rate specials being rolled out by banks. And this perhaps means the RB can be a little patient before delivering on that first OCR cut. There's few certainties in financial markets, yet when I look at the data there, I think you can be reasonably confident that the easing cycle will begin towards the latter part of this year. Yet when we look at market expectations, it feels like they're being overly optimistic around the timing of these cuts. Markets are reading a hang of a lot into the 176 words of the NPR and the associated meeting summary of some 742 words. It's worth touching on how the RB's process differs for an NPR as opposed to an MPS. A NPR is a reasonably light 2-day process where on Monday they have a day of data presentations called the first pass. On Tuesday, they discuss policy strategy and draft the minutes and the statement, whilst Wednesday typically sees a draft review with any small tidy-ups before publication. By contrast, an MPS has a comprehensive process that runs over a week and a half. It starts with the provision of a document pack 2 Fridays prior to the MPS date. Then presentations commence the following Monday and run through to Thursday. Following that, we have deliberations on communication and policy strategy starting on the Friday and running through to the Tuesday prior to publication of the statement on Wednesday. Given this massive difference in the level of review, the inferences markets are making around the pace of cuts are enthusiastic and look to be pricing close to perfection. Rather than spending too much time thinking about when that magic first cut is going to occur, I think one should focus more on the end point of this potential coming easing cycle, remembering the poor state of our economy and the RB's estimate of neutral at 2.75%. If we take this longer-term view, market pricing of a OCR at around 3.5% in 2 years' time looks more reasonable and is not dissimilar to what we see in the chart on the right from other global central banks. Remembering again that New Zealand's economy is in a worse economic state than these peers. Ultimately, the Reserve Bank's August MPS will allow them to clarify and explain their position and set the scene for these future rate cuts. Our central view remains that cuts occur in November, with some risk of a start in October, should the RB set an appropriate foundation for this in their August MPS. We cannot completely rule out an August cut, but the hurdle is reasonably high. Ultimately, for bonds, Should the RB begin cutting earlier, it likely means a shallower OCR cut profile, whilst if they wait too long, a more aggressive OCR cut profile will be required as the economy tips back towards recession. As far as this relates to duration, our bond fund is currently close to its maximum allowable duration position. This has been rather positive for performance over July. Absolute returns are some 2.5%, this being an outperformance of around 50 basis points for the month. Our position on duration is currently a hold, with thoughts turning to when to start reducing positions, as markets have already priced a large portion of the RB's future cuts. This is not to say the rally is all played out. Our 10-year government bond, for example, currently sits at around a yield of 4.4 to 4.5%. And given the state of our economy and other global economies, a level of 4% would not be historically extreme, especially if the RB takes the OCR back towards neutral. From here, we're waiting on a number of key events which will help determine how fast and far rates fall. We need to see the RB actually deliver a cut and present their forward view. The Fed cutting, along with their communication, will also be pivotal. Whilst on the domestic data front, unemployment numbers and third quarter CPI are going to be really key data points. I might just pause there. Hopefully I've provided some insight in our view on the OCR and monetary policy, and I'll pass back to you, Stu, for any questions.
Yeah, thanks, Matt. I was furiously writing down questions as you were going through, and then you pretty much answered them all as we went along. So it's an awesome presentation. Thank you. And yeah, we look forward to the next update and seeing what happens and how quickly the central bank moves. And I found the explanation of the 2-day versus the 7 to 10 days very interesting, something I didn't know. So thanks for that new information. We're going to move on to Michael de Cesare. So yeah, it's an interesting time to look at markets. The New Zealand markets has been on a bit of a tear, and there's a lot of corporate news out, and there's some M&A stuff that I think Michael will touch on as well. So we're right on time, Michael, and hand over to you. Thanks very much.
Great, thanks, Stuart, and good morning to the audience. It's nice to be presenting the equity market update to you again. As Stuart mentions, I'm going to hone in on company-specific information that's emerged in July before helping to explain the dynamics at play in our market. If we move to the first slide, please. Yeah, if we move to the slide with the information flow. Thank you. Thanks. So there has been a lot of information come out, so I've tried to present it in categories, common categories as such. If we start at the top left there, mergers and acquisitions, Arvida, the retirement and aged care provider, received a takeover offer by Stone Peak, a US investment firm, for $1.70 per share. Given the stock was trading at 103 the day before, it's a pretty decent premium. We think that the deal goes through, partly because this is the same crowd who bid for the company in the past. The board actually did not inform investors of the interest and subsequently learned that the investors would have been very keen to go ahead with the deal. So given it's a similar deal, it's an all-cash offer, and the board unanimously recommends voting for it, we see a high chance that it goes through. There is some formality to work through with the OIO, given the sensitivity of land ownership in New Zealand. The process is targeting completion by the end of this calendar year. The OIO could mean there is some slippage into 25, but ultimately we think it gets done. EBOS Group, the medical and pet food wholesaler and distributor, they were heavily linked with a move for a premium pet food company called Prime 100, which would have been sold by a PE firm. I just thought I'd include this because it gained a lot of attention from the media, but EBOS actually came out the next day and said they won't be involved in any process for the company. While that's interesting, we do think EBOS are in the market for a pet food company. From a small base, that segment of their business has grown to now be 20% of earnings, so quite sizable. And the growth rate means it's going to become ever important. So if the right deal does emerge, and these guys have a great track record, we do think that they will try to pursue and attain a deal such as this. If we move over to the top right corner on regulation, so the Australian government's approved the ANZ Suncorp deal, albeit with conditions. So this paves the way for the largest deal in the sector for over a decade at 4.9 billion Australian dollars. The conditions involve over a 3-year period, no net employment reduction related to the deal, and also no closure of regional branches. Our views the deal is okay, but it doesn't add tremendous value. And given the long-dated nature, meaning we have to wait quite a long time before we see the benefits flow through, we're not too excited about it, and especially because it also means that it disrupts the short to medium term dividend story, which was so well supported over recent times and helped the bank move higher. Moving on to Auckland Airport, the Commerce Commission has claimed that their prices may be too high. This was via a draft report which indicated they're targeting a return above what the ComCom believes to be reasonable. This was somewhat expected. Auckland Airport will provide additional context, however, went to great pains to explain that if the final report still says prices are too high, they will adjust the prices. We believe they've made that so abundantly clear to squash the rumours in the market that Auckland Airport could be taking a more aggressive stance against the Commerce Commission, which we think would have been foolish, really, because they operate under a light touch, favourable regulatory regime. So to risk the stick being a change to a more strict regime would be unwise. So we think that's the right thing to do. And we had already modelled prices below what Auckland Airport had been stating. So it's in line with our expectations. The Commerce Commission also presented the draft conclusion for Chorus. This is for their second regulatory period. That's from 2025 to 2028. It essentially states the return they can achieve and their what they call the maximum allowable revenue, or a revenue cap, if you will, over that period. It came in largely in line with market expectations, albeit unsurprisingly, Chorus still want to improve their return. They're trying to get more of their shared costs in their business allocated under their regulated fibre business, which would improve returns rather than under the copper business. Whether they get that or not, we do believe that they're really well placed to grow their dividend per share by 37% through to FY28, which would be equivalent to a 7.5% cash yield. Overall, with the OCR likely to be trending lower and higher yield opportunities becoming harder to find, we think this opportunity would potentially be attractive to the market, especially given the defensive nature of the earnings in which the dividend is based off. The company acts as a monopoly on nationwide optical fiber broadband. So very defensive and benefiting from the long-term trends of increased data usage per person, which I'm sure we all would agree that we're all using more data these days and likely to use more in the future. Moving to capital raisings and sell downs, the middle section on the left there. The Bay of Plenty Regional Council are considering selling part of their Port of Tauranga stake. This would be a similar move to Auckland Council, who sold a large position in Auckland Airport not too long ago, if you remember. The council actually own 54% of the company, which is quite staggering, really. It still requires a second vote by the council, but the decision would allow them to sell as much as 26%. which would equate to 1 billion New Zealand dollars. Our view is that Port of Tauranga, despite being a cyclical play and therefore facing some earnings headwinds at the moment, with a soft result expected next month, you can't dispute that it's a high quality opportunity, it's a high quality asset, so we think demand will be there. We are a little uncomfortable about the size of the deal because as part of our investment process, our risk analysis, we analyze the liquidity of companies, and using our methodology, which relies on the last year, 2 years of average shares traded per day. A normal seller would take them 353 days to move that amount of stock. So it's just worth noting, on one hand, you've got a great company. On the other hand, there could be some digestion issues given the size of the deal, should they go ahead and realize some funds from their position. Moving on to Synlait would have liked to be in the mergers and acquisitions segment, but they're not. They claimed that they would be able to sell dairy works and solve their debt issues. However, surprise, surprise, when people know you're a forced seller, Synlait received a lot of interest, but no price close to where they saw value. So as a result, they've had to agree with their banks on waivers to covenants and other metrics, which has allowed them now to reach a position where they plan for an equity raise. We think Synlait are somewhat fortunate to have such strong shareholders that support them, and also clearly the best part of their business being tied to a highly successful infant formula player whose performance has been outstanding of late, and looks like they're set to deliver a fantastic result next month. I'll let you just read the leadership changes in the middle on the right side there. Moving to the bottom left, company guidance. Serco, the travel software company, has reaffirmed their FY25 profit guidance, which will provide comfort to a lot of people who are still calibrating the Booking.com deal. Somerset, the large retirement village operator in New Zealand, has said that their first half profit next month will be similar to last year. This is despite their sales running 20% ahead of last year on current run rate, but the conditions in which they face has been tougher. So that's the main reason. We do think they're the highest quality play in New Zealand, and they're expanding into Australia via Victoria and Queensland, which provides scope for a long-term growth story there. Port of Tauranga, once again, a tax law change on depreciation of commercial buildings means they'll have to recognise 12.9 million deferred tax expense, not immaterial when their underlying earnings expected for this year is 100 million. Contact guided to a dividend track below market expectations, and this is largely due to generation shortfall. We are disappointed by this, but we do think that the renewable energy story, the strong earnings growth that will still be delivered, combined with the electrification of industry and fleets over the long term, all complemented by the recent New Zealand aluminium smelter and Rio Tinto deal, which is set to last for 20 years, which significantly improves the industry structure in which they operate. So we still like Contact and think they will do well from here. And Synlait just updated the market that their earnings will be below the previous guidance. Fletcher Building, you can read that for yourself. Also, Contact have committed to a large grid-scale battery, which adds flexibility to their operation, which we think is a positive thing. Infratil's Canberra data centre stakes value has increased by 11% since March, just from the 31st of March, which is staggering. They're set to triple their capacity over the next 4 years and already have significant contracts in place for that, so it's somewhat de-risked. If I've got time, just a couple of minutes, I'll move over to the next slide, please. If we can move to the next slide, which will show the performance of the NZX 50 by stock. It's clearly been an incredible month so far. I do apologize that it's somewhat dated. It's to when this presentation was made on the end of Wednesday, the 24th of July. But you can see that there are several, well, most of the market's up. Actually, 45 of the 50 stocks at that date were up, and 18 of which were delivering double-digit returns. So this is clearly not normal. It's a reflection of the dovish turn in which the RBNZ has taken. In addition to significant material information and interest rates, stocks can move for various reasons. I think Andrew referred to it as fund flow. We often call it rotation. And at present, the underperformers are the safe, large, liquid names which have been used as a safe haven for investors who seek refuge in those stocks during these difficult macroeconomic times. However, the rotation that's happening is quite significant, and they're being funded. They've been used as funders to move into small and mid caps who have significantly outperformed large caps, to move into cyclicals, housing-related stocks, financials, industrials, and those with consumer exposure. Not too dissimilar from the move in the US, where the Magnificent Seven's being sold for funding for investors to increase the breadth of their investments. Just finishing on the last slide there, please. Here you'll see the performance of the SRI equity fund. I've used this fund because it's the one I manage, but you'll see similar charts for other funds with the active investment approach and fundamental research benefits being listed there on the left side. You'll see that over all key periods, the SRI fund has significantly outperformed the benchmark, the NZX 50, and what we use as a proxy for passive funds, just outlining and reaffirming the benefits of active management and fundamental research. I'll stop there in light of time and pass back to Stuart.
Thanks very much, Michael. Really interesting presentation, and congratulations to you and the team on those 5 and 10-year results. I and investors appreciate that. So really interesting presentation. Thank you very much. I'd also like to thank everyone who's online for joining us today. Got a few questions that came through, so that's really helpful and engaging. And we hope you have a good weekend and next month, and we will see you again shortly. Thank you very much for your support. Goodbye.
Thank you.